Well, why do we want to have information about the accounting statements and the balance sheet in particular? The primary purpose of financial statements is not to report market values. The purpose is to detect theft, gross misuse of resources, and ensure that the earnings generated were measured and reported fairly and consistently over time. Used a lot by creditors, somewhat by investors for valuation, but honestly not as much. It's very important to compare financial statements to prior years. Are profits and/or expenses going up or down? How fast is the business growing? It provides information about the firm's current financial position. What effect have past decisions had on the firm? Is the firm able to meet its debt obligations? What sort of legal and financial problems does the firm have? All of these are questions that creditors and investors want answered. Accounting very, very much is the language of business. Accounting itself, in my opinion, tends to be looking backward, very historical looking, and finance is more forward looking. But again, we need to know that language and be fluent in that language in order to understand accounting. Now, let's look at the balance sheet. Lists all the assets, all the liabilities, which are the easiest to convert in cash, listed first, the most difficult to convert into cash, listed last. Now that last bullet point, the balance sheet identity. Assets are equal to liabilities plus shareholders' equity. That is a very important point, a very key point, and please make a star of this point. You're going to be using this relationship many, many times, not just in this chapter, but in later chapters as well. Now, a question to think about. Why might shareholders be willing to take on more risk than bondholders or preferred stockholders? Why does this balance sheet identity say shareholders are more willing to take on risk? Now, liquidity is also important. When we talk about liquidity, when we list the assets, we want assets that are able to be converted to cash quickly, and the important qualifier, without a significant loss in value. That we are able to take those assets, like accounts receivable, get most of their value. Cash, of course, is cash. Inventory, maybe yes, maybe no. Maybe you can sell inventory for its value. Maybe you'll have to take a loss in a fire sale if you're trying to sell that inventory quickly. So some assets are more liquid than others. Some firms are more likely to withstand financial distress than others. Firms that have assets that have other uses that they could transfer fairly easily to other businesses are less likely to experience financial distress. Liquid assets typically have a lower return, and that goes back to the risk-reward relationship. If something is safer, if it's more easily converted into cash, that makes it safer, and you're going to see a lower return attached to that. So the firm has to find a balance between liquid and illiquid assets. They want liquid assets so they have that cash available when needed, but they know their illiquid assets are going to earn a lot more. And those are the ones that are going to make the most returns for the company. Net working capital, do know the definition of net working capital, and we'll be looking at what values it should take. Your textbook says that it's usually positive in a healthy firm, and that's true. However, these days, many firms strive for zero net working capital. If you're a manufacturing firm, probably can't do that. But if you're a human capital firm, you can try very hard to make sure that you delay your bills long enough until you've received that cash and strive for a zero net working capital. Finance focuses far, far more on market value than on book value. Market value tells us what's the ongoing value of that firm. How do investors value that firm? Assets are typically listed at their historical cost, less accumulated depreciation. That may be totally and completely unrelated to what you could sell an asset for. Human capital. Many companies have patents, customer lists, brand names. Those aren't listed on the balance sheet, yet these are assets that have a lot of value. That's going to be reflected in the market value of the company. Let's look at Amazon. Amazon in 2006 had a book value of equity, common shareholders' equity on the balance sheet, of $431 million. Now they had a market capitalization, or market value of equity, or market cap, all terms for the same thing, that's equal to the number of shares outstanding times the price per share. They had 414 million shares outstanding. The shares were selling for $39.46 per share, which gave them a market value of equity of $16,336,000. Now, if you look at the ratio of market value to book value, their market value was 39 times their book value. That's huge. We'd like to have a floor of at least 2 times, but 39 times, hey, that's fantastic. Well, 2007, still pretty darn good, but not quite as good as it was before. 2008, well, 2008 was a bad year. Financial crisis. Many companies, particularly companies that had discretionary items, and certainly buying from Amazon was discretionary, saw their sales fall and their profits fall. Well, that happened to Amazon.com as well. They had a greater amount of book value of equity, but look what happened to their share price. $92 in 2007, down to $51 in 2008. Then 2009 came, and they were able to recover. Their share price is back up there, back beyond its peak in 2007, an even higher price. And now, comparing their book value, which has gone up substantially, they've acquired a lot more assets in this time period. Their market to book value is 11.4. Their market value is 11.4 times their book value. So that measure is very important. Think about why Amazon has such a high market value to book value. I've talked about why it was high and why it fell and why it came back up again. But why is it so high to begin with? Far higher than average book values.